In 2020, the U.S. market erased 34% of its value in just 23 trading days. But here's the kicker. During that bloodbath, the best performing investors weren't the ones with Ivy League degrees. They were the ones who couldn't log in because they were either dead or had forgotten their passwords. While everyone else was panic selling, these accounts stayed the course and won. When the market tanks, your brain stops being a rational investor and starts acting like a caveman running from a predator. Financial loss actually triggers the same part of your brain as physical pain, like burning your hand on a stove. Today, I'm showing you the 6 moves that actually work during a crash, so you don't turn a temporary dip into a permanent financial disaster. Part 1. The biology of financial failure. When the market plummeted 34% in early 2020, it only took 23 days to erase years of gains. Interestingly, a Fidelity study discovered that the most successful accounts during such crashes often belonged to people who were either deceased or had simply lost their login credentials. While the smart investors were busy reacting to headlines, those who literally could not touch their money outperformed them. This happens because our brains are not designed for the stock market. They are designed for survival. When your portfolio value drops, your brain doesn't see numbers, it sees a threat to your existence. Neuroscience reveals that financial loss triggers the anterior insula, the same region of the brain that processes physical pain, like burning your hand on a stove. When markets crash, your rational thinking software shuts down, replaced by an ancient survival system evolved for the savannah. This is why even brilliant people make devastating choices. They are trying to escape pain by selling at the bottom. Data from the 2008 crisis shows the average investor earned only 1.9% annually over 20 years, while the S&P 500 returned 8.2%. That massive gap wasn't due to bad stocks. It was due to human behavior, buying high out of greed and selling low out of pure neurological terror. To win, you don't need a higher IQ. You need a system that protects you from your own biology. We are going to walk through 6 specific moves that don't just make financial sense, they make psychological sense. These strategies are built for the version of you that is panicking at 2 a.m., not the calm version of you reading this right now. They accept that you will be scared and irrational, and they ensure the right thing happens anyway. Coming up next, how a simple firewall can help you build 73% more wealth without you ever having to make a single difficult decision. Part 2. Building your defensive shield. The first major move is the automation firewall. Every expert will tell you to keep investing when prices are low, but during a crash, your body is flooded with cortisol, making that rational choice feel impossible. Research from the University of Chicago found that investors who automated their contributions during the 2008 crash ended up with 73% more wealth a decade later than those who tried to time their re-entry. The winners weren't braver, they just removed themselves from the equation. By setting up automatic transfers and rebalancing, you bypass the need for willpower, which is a resource that drains rapidly under stress. The second move is the cash buffer zone. This isn't just an emergency fund, it's psychological armor. You need 6 to 12 months of liquid cash in a high-yield savings account. When you lack this cushion, financial scarcity kicks in, which Princeton researchers found can lower your effective IQ by 13 points. Essentially, being broke makes you less capable of thinking clearly. However, households with modest savings are 2.5 times less likely to make panic-driven mistakes. This cash gives your nervous system decision space, the room to breathe and realize that even if the market drops, your rent and groceries are covered. Most people view idle cash as a waste because it isn't working during a bull market. But in a crash, that cash is what keeps you out of survival mode. It allows you to stay invested when everyone else is cashing out in a frenzy. You aren't being weak by needing these safety nets. You're being a realist about how human beings actually function under pressure. But what happens when your portfolio gets out of balance? In the next part, we'll look at the legal cheat code that can add hundreds of thousands of dollars to your net worth. Part 3. The Mechanical Advantage. Move 3 is the rebalancing trigger. During a crash, your portfolio's proportions shift. If your goal was 80% stocks and 20% bonds, a 40% market drop might leave you with only 67% stocks. Every instinct will tell you to sell more stocks to stop the pain. But the cheat code is to do the exact opposite. Sell bonds and buy more stocks. Disciplined rebalancing during the 2008 to 2012 period added about 0.35% in annual returns, a figure that can result in over $200,000 in extra wealth on a $500,000 portfolio over 30 years. Because this feels psychologically wrong, you must automate it using percentage-based triggers, so your amygdala doesn't have a vote. Move 4 involves income diversification. Market panics rarely stay confined to Wall Street. They often bleed into the job market, as we saw in 2008 and 2020. When your portfolio is down and your primary paycheck is at risk, you are 4 times more likely to make a catastrophic mistake, like withdrawing retirement funds at a massive loss. However, having even a small secondary income stream, freelancing, dividends, or rental income, provides the psychological security needed to prevent a panic cascade. Strategic redundancy isn't about working 80 hours a week. It's about ensuring your brain doesn't treat every economic headline as a survival threat. When you aren't reliant on a single point of failure, you can watch the market fluctuate without feeling like your life is ending. This stability allows you to remain rational while others are governed by fear. Think you're staying informed by watching the news? Next, I'll show you why the latest updates are actually making you poorer and how to stop the manipulation. Part 4. Controlling the narrative and opportunity. Move 5 is the anti-news protocol. It sounds counterintuitive, but consuming financial news during a crisis literally makes you poorer. Investors who check financial media daily trade 40% more often, which reduces their returns by an average of 1.5% annually. Over a long career, that information could cost you over $300,000. Crisis news isn't designed to inform you. It's designed to activate your fear response, because emotionally charged headlines spread 6 times faster. To fight this, you must delete news notifications and limit portfolio checks to once a month. Being less informed actually makes you a better investor because it protects the willpower you need to stay the course. Finally, Move 6 is the Opportunity Fund. This is what separates those who merely survive from those who build generational wealth. While an emergency fund covers your bills, an opportunity fund is cash specifically set aside to buy assets when they are on sale during a downturn. Everyone knows the mantra, "Be greedy when others are fearful," but loss aversion makes it nearly impossible to execute in the moment. Losses hurt 2.5 times more than gains feel good, which paralyzes most investors when the S&P is down 35%. By pre-deciding what you will buy and at what price, you move the decision-making process to a time when you can think clearly. Research shows that institutional investors with a predetermined crisis plan outperform reactive ones by 3.2% annually following a crash. This small edge is the difference between retiring comfortably and having nothing to leave your children. We've covered the moves, but how do they all fit together to change your future? In our final section, we'll look at the hidden pattern of wealth, Part 5, the systemic path to wealth. When you look at these 6 moves together, a clear pattern emerges. None of them require you to be a genius, a market forecaster, or a finance pro. Instead, they focus on building a structure that works when your brain won't. We have to accept that as humans, we are running biological software, optimized for physical threats on the savannah, not for navigating 401k rebalances. You aren't weak for feeling the urge to sell during a crash. You are simply reacting to a survival instinct. Success isn't about having more discipline. It's about having better systems. By using automation when willpower fails, keeping cash when fear takes over, and following preset rules when emotions run high, you stop fighting your biology and start working with it. These systems ensure that even when you are terrified and irrational, the right financial moves happen anyway. If you've made mistakes in the past, stop beating yourself up. You weren't failing. You were just being human. The goal of these 6 moves is to turn a temporary market drop into a permanent financial advantage. While everyone else is busy reacting to the chaos, you will be the one with the armor, the plan, and the opportunity to grow. It might feel boring or unproductive during the good times to have cash sitting idle, or to ignore the daily news. But that is exactly what makes it brilliant when the world feels like it's falling apart. Would you like me to help you draft a specific opportunity fund plan or a rebalancing trigger schedule based on these strategies?